Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, macro developments, sector trends, and investment themes shaping the day. Today is Friday, May 15th, 2026. We're Elena and Marcus.
And if you're managing institutional capital today, you're waking up to a completely shifted landscape.
Right. I mean, imagine waking up to find that the very foundation of your macro portfolio, the supposedly risk-free government bond, is suddenly exhibiting the volatility of a speculative tech stock.
It's a harsh reality. Today's session was dominated by a violent global risk-off rotation, and we are tracking 3 essential takeaways from the data deck that are, frankly, altering the macro landscape for your portfolio.
So let's start with the first essential takeaway, which is the global bond breakout.
Right. The 30-year U.S. Treasury yield has decisively broken its October 2023 cycle peak. We closed at 5.12%, which is, well, it's the highest level since July 2007.
And this severe repricing isn't just happening in a vacuum, right?
Correct. It's being driven by an acute energy supply shock, along with a concurrent surge in the 10-year real yield past 2.07%. And we'll break down exactly why that specific real yield threshold is so toxic for asset valuations in a moment.
Which brings us to the second takeaway, the mega cap tech reversal and emerging market capital flight. If you look beneath the index level, we're observing a really severe narrowing of equity breadth.
Yes, the cap-weighted S&P 500 fell 1.24%.
Dragged down mostly by a sharp 4% drop in semiconductors. Yet, and this is key, the equal weight S&P 500 actually closed up 0.37%. Concurrently, we are tracking a historic liquidity drain abroad. Emerging market Asia ex-China saw a record $17 billion in foreign outflows,
which triggered that massive 6.12% single-day plunge in the Kospi.
Exactly. And the third essential takeaway is the credit market disconnect. Despite the surging risk-free rate, high-yield corporate spreads remain inexplicably tight at 304 basis points.
It's a glaring contradiction. This is occurring even as institutional research highlights deteriorating underlying fundamentals across the corporate sector. We're seeing corporate leverage hitting 3.5-year highs.
And interest coverage ratios dropping to 19-quarter lows. I mean, there's a massive disconnect between what the equity volatility market is pricing and what the underlying corporate balance sheets are actually signaling.
Right.
Moving to the desk data, let's examine the proximate geopolitical catalyst for today's price action. The trigger centers squarely on the failure of the Trump-Xi-Beijing summit.
The meetings concluded without any tangible breakthrough regarding the 11-week blockade of the Strait of Hormuz.
And for your portfolio, this means the global crude oil surplus that it, previously cushioned the physical market is rapidly dwindling.
So the geopolitical risk premium has reignited mechanically. WTI crude surged above $105 per barrel today, and Brent pushed above $109 per barrel.
And the bond market reaction to this exogenous energy shock was immediate and severe. We're observing a classic bear steepening dynamic across the yield curve.
Right. And to define that for your portfolio positioning, a bear steepener occurs when long-term interest rates rise much faster than short-term rates.
The 10-year yield spiked 11.5 basis points to 4.60%. That's its highest level since February 2025. Simultaneously, the 30-year yield pushed through critical technical resistance to hit that 5.12% mark.
We also saw corresponding stress globally. I mean, the UK 10-year yield hit 5.15%, a level not seen since 2008.
And Japan's 30-year yield reached 4% for the first time, which severely complicates the Bank of Japan's normalization timeline. But I'm looking to the scale of this yield spike, and we need to apply some rigorous historical context here.
Yeah.
Let's translate what this actually means for the broader market. Is this merely a temporary duration repricing, similar to the October 2023 peak of 5.11%? Because in that cycle, the market stabilized quickly and risk assets rallied sharply once yield peaked. Why should an asset manager treat today's 5.12% breakout differently?
It's a fair question, but the underlying mechanics of today's market are fundamentally different. Institutional research highlights that the 2023 yield spike was driven by robust economic growth, right? And a highly resilient consumer absorbing that cost of capital.
While today's breakout is entirely stagflationary.
Exactly. It's driven by an exogenous oil supply shock colliding with persistent, effectively unlimited fiscal deficits. The government is issuing massive amounts of debt at the exact moment inflation expectations are breaking higher.
I see.
Furthermore, the composition of the yield is critical. 10-year TPS, which represent the real yield after subtracting inflation expectations, have climbed to 2.07%.
Let's unpack the mechanics of that 2.07% real yield, because it really is the linchpin of today's market rotation. For the portfolio manager listening, when real yields cross that 2% threshold, It acts as the primary mathematical trigger for severe equity multiple compression.
Right, because if you're valuing a long-duration asset like a mega-cap technology stock or a high-growth semiconductor company, your valuation relies on discounting future cash flows back to the present.
So when the real risk-free rate hits 2.07%, the discount rate you must use in those models rises sharply. The nominal yield level matters, of course, but the real cost of capital is the binding constraint on valuations. It mathematically forces the terminal value of these growth companies lower.
Correct. And that mathematical constraint is further complicated by the Federal Reserve transition overlay. Let's not forget, today is Jerome Powell's final day as Fed chair.
Right. Kevin Warsh is inheriting a bond market that is actively testing his inflation-fighting credibility before his first FOMC meeting even takes place in June.
Indeed. Institutional consensus is rapidly repricing. The market is not only pricing out rate cuts, pushing them deep into late 2026 or early 2027, but major dealer desks are also beginning to price in a non-trivial probability of an outright rate hike to defend the currency.
On that point, the rising cost of capital should mechanically force a repricing of risk across both credit and volatility markets. Yet, if you look at the screens right now, we are observing a significant paradox.
The volatility indices remain unusually subdued.
Exactly. The VIX sits at just 18.43. And more notably, the UVE index, which measures bond market implied volatility, is surprisingly low at 69.63.
That's well below its March highs.
Right, despite these historic yield breakouts and duration sell-offs.
Which brings us directly back to the credit market disconnect we outlined at the top of the briefing. High-yield ETFs are seeing robust inflows, and spreads are tightening to 304 basis points.
Wait, help me make sense of this paradox. Remind us of the mechanics here. Why are high-yield ETFs seeing robust inflows and spreads tightening to 304 basis points, even as institutional research shows underlying corporate leverage hitting 3.5-year highs and interest coverage ratios falling to 19-quarter lows? If companies are struggling to cover their interest expenses under the weight of a 5.12% 30-year yield, why on earth are investors pouring capital into high-yield ETFs? What's the mechanical flow driving this seemingly blind buying?
It's a classic bifurcation between market technicals and underlying fundamentals. Think of these high-yield ETFs like buying a sealed shipping crate of fruit at a wholesale market.
Okay.
Because domestic retail investors are so desperate to capture yield in an inflationary environment, they just keep buying the sealed crates. The ETF providers, the authorized participants, are structurally obligated to fulfill that demand.
Right. So when capital flows into these passive vehicles, the authorized participants must go out and blindly buy the underlying cash bonds that make up the index to create new ETF shares.
Exactly. They are not conducting granular credit analysis on the individual companies. They are buying indiscriminately to match the index weightings.
So this price-insensitive buying is artificially compressing the credit spreads and completely masking the fundamental decay occurring beneath the surface.
Indeed. We see this decay particularly in private companies and consumer asset-backed securities. Major dealer desks are reporting record delinquencies in the auto and credit card sectors.
But the buying continues.
Yes, to fulfill the relentless reach for yield, capital continues to flow aggressively down the quality spectrum. Authorized participants are sweeping up CCC and BAA tranches,
Which suppresses the aggregate index spread.
and allows the market to temporarily ignore the rising default risks associated with a higher-for-longer rate regime. The technical flow is overriding the fundamental reality.
Understood. Pivoting from credit technicals to actionable equity strategy, let's examine how this stagflationary macro regime is creating extreme portfolio leadership divergence across sectors.
It's quite stark.
If you're looking at your sector allocation, energy was the only S&P 500 sector to close in the green today, up 2.36%. It is serving as the primary defensive leadership against the physical inflation impulse.
In sharp contrast, we are seeing extreme vulnerability in rate-sensitive cohorts. The Russell 2000, which is heavily populated by small-cap companies relying on floating-rate debt, dropped 2.44%.
Because when short-term borrowing costs stay elevated, those companies see their margins evaporate immediately.
Precisely. And more critically, the previously unassailable AI and semiconductor trade faced heavy distribution, with the SOX index falling 4.02%.
The underlying breadth data provides a critical signal here regarding the exact nature of this vulnerability. As we noted earlier, the cap-weighted S&P 500 fell 1.24%, but the S&P 500 equal weight index closed higher by 12.37%.
This divergence is crucial for portfolio strategy. It confirms that the selling pressure is not a broad market capitulation driven by total economic panic. Rather, it is highly concentrated in mega-cap technology and levered semiconductor ETFs.
Let's connect that back to the real yield discussion. These mega-cap assets have essentially functioned as the market's primary duration proxies for the last 2 years. Because their valuations are so heavily dependent on earnings projections 5 to 10 years out, they trade very much like long-term bonds.
Right.
When real yields surge past that 2% threshold, the terminal value assumptions of these mega-cap growth stocks face a sharp, unavoidable mathematical repricing. You simply cannot justify a premium multiple when the risk-free alternative yields over 5%.
Correct. And this duration repricing in the United States is mechanically accelerating emerging market contagion risk. We are tracking the combination of a rising U.S. dollar, which just posted its best weekly performance since early March, and surging U.S. real rates.
For a portfolio manager operating in emerging markets, that is a toxic combination. It mechanically draws capital away from developing economies. This is why we are tracking that record $17 billion foreign exodus from emerging market Asia ex-China.
Let's detail exactly how that mechanism works for the listener. Why does a strong U.S. dollar force such aggressive liquidation in Asian equities?
Well, when the yield on a supposedly risk-free U.S. Treasury hits 5.12%, institutional capital naturally flows back to the United States to capture that yield.
Right. And to buy those treasuries, foreign institutions must buy U.S. dollars,
which drives the value of the dollar up relative to local currencies like the South Korean one. This makes it more expensive for emerging market companies to service their dollar-denominated debt, and it erodes the local currency returns for foreign investors. The capital flight becomes a self-reinforcing cycle.
And the geographic concentration of that capital flight is highly specific to the semiconductor supply chain. Korea experienced $13.2 billion in outflows alone, triggering that massive 6.12% single-day plunge in the Kospi. Taiwan also dropped 1.39%.
What's notable here is the severe disparity in institutional versus retail flows. While domestic retail investors in Korea are attempting to step in and buy the dip, adding $14.1 billion in domestic liquidity to the market, the institutional de-risking is entirely overwhelming them.
Foreign institutions are actively stripping the speculative froth from the over-leveraged technology trade. They are liquidating positions and overriding highly attractive forward price-to-earnings multiples because the macro mandate demands a reduction in risk exposure.
This brings us to a critical inflection point, where the prevailing market consensus may be fundamentally mispriced. If you survey the analyst consensus across major asset managers, the dominant narrative remains a clean, soft landing.
An environment where inflation cools, growth slows gently, and the Fed eventually cuts rates.
Right. However, proprietary modeling from regional Federal Reserve surveys paints a significantly darker picture. The St. Louis Fed GDP nowcast currently projects a meager 0.78% growth rate for the current quarter.
Simultaneously, Philadelphia Fed forecasters are projecting Q2 CPI to average an annualized 6%.
If those regional models are accurate, the macro regime has already shifted decisively from a high-growth environment into a textbook stagflationary environment.
This is the tail risk that the broader market has not fully digested. The current market pricing embedded in equity valuations assumes that the Federal Reserve will eventually cut rates to support economic growth when it decelerates.
But in a stagflationary environment, where the exogenous oil shock limits the central bank's ability to ease monetary conditions and decelerating growth pressures, corporate profit margins, traditional portfolio construction, completely breaks down.
Let's explicitly define what that breakdown looks like for a standard 60-40 portfolio. If you are holding 60% equities and 40% bonds, your core assumption is that bonds will act as ballast when equities fall.
Right. In a standard recession, growth drops, equities sell off, but the Fed cuts rates, which causes your bond portfolio to rally and offset the losses.
But under the stagflationary conditions we are observing today, the correlation between equities and bonds turns positive. The energy shock drives inflation and bond yields higher, crushing your fixed income allocation, while the resulting high cost of capital crushes corporate margins and equity valuations.
Both asset classes draw down simultaneously. The diversification benefit that institutional portfolios rely upon is completely removed.
Which brings us back to the structural vulnerabilities hidden beneath those tight credit spreads. The passive technical flows into triple C and Baa tranches are temporarily masking the stagflationary reality. But technicals cannot override fundamentals indefinitely.
No, they can't. As refinancing walls approach over the next 12 to 18 months, companies will be forced to roll over their existing debt at these new punitive 5.12% rates.
That is when the interest coverage ratios, currently sitting at 19-quarter lows, will translate into hard defaults, particularly in those highly levered private companies and consumer asset-backed securities.
So, to recap the essential takeaways for today, we are monitoring the decisive 5.12% breakout in the 30-year U.S. Treasury yield, driven by acute energy pressures and an 11-week blockade in the Strait of Hormuz. We are observing a violent rotation out of mega-cap tech and a severe emerging market capital flight, evidenced by the Kospi's 6.12% plunge as foreign institutions liquidate semiconductor exposure.
And finally, we are tracking the structural vulnerabilities hidden beneath superficially tight credit spreads as passive ETF flows mask deteriorating corporate fundamentals and rising consumer delinquencies.
This leaves us with a final institutional consideration regarding Kevin Warsh's incoming tenure at the Federal Reserve.
Right. If the bond market continues to force real yields higher to digest effectively unlimited government debt issuance amidst a sustained energy shock, the traditional monetary playbook is void. Will the new Fed leadership be forced to execute a rate hike straight into a decelerating economy, simply to defend their institutional credibility and stabilize the currency?
That is the tail risk your portfolio must now weigh. Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back next week with the latest market color and cross-asset analysis.